In this video, we're going to walk through problems involving bonds issued at par, at a discount, and for a premium. We're told that the Celine Dion Company issued bonds on January 1, 2020. Interest is payable semi-annually on July 1st and January 1st. The Dion Company uses a straight-line method of amortization for any bond premium or discount. For our first problem, our information is given below. We're told the par value of the bonds is $600,000. The stated interest rate, and again, that's the interest rate used to figure out the cash or coupon payment, is 10%. The bond has a 20-year term, and the price is at par. That means we'll receive an amount equal to $600,000 at the time we issue or sell the bonds. We always record bonds at their par value or face value. We are also at this time receiving $600,000 in cash. Both of those are given. On July 1st, 2020, we're going to make our first interest payment. The amount of that interest payment will be $30,000. That's the $600,000 par value times this 10% stated interest rate times 6 months divided by 12 months, or times 1/2, because these are semi-annual coupon payments. And our debit is to interest expense. And our interest expense will always be equal to the amount of cash paid, the coupon, plus or minus any amortized premium or discount. Since the bonds were issued at par, there is no amortized premium or discount. On December 31st, 2020, we're not going to make an interest payment, but we need to accrue interest. We owe 6 months of interest. That'll again be the $600,000 face value or par value times the 10% times 0.5 or 6 over 12 months for half a year. And of course, the other half of the interest entry is a debit to interest expense. Now let's consider a second scenario where the bonds are issued at a discount. We have the same bonds, but the issue price is at 95. That means 95% of the par value. Once again, we always record bonds at their face value or par value, so we'll credit bonds payable for $600,000. We're only going to receive $570,000. That's the par value of $600,000 times 95% or 0.95. Debits don't equal credits, and so we're going to need to debit a discount on bonds payable for $30,000. We will be amortizing that discount over the life of the bonds, 20 years, on a straight line basis. And again, this is a semi-annual coupon, so it will be for 40 periods. Let's take a look at the calculation of our interest payment and related amortization and interest expense on July 1st, 2020. Our interest expense is going to be $30,750. That's going to be the amortized discount of $750. And again, that's $30,000 divided by 20 times 2, plus the actual cash we pay, which was $30,000. So once again, the 10% stated interest rate determines the amount of cash we pay on the bonds. Our discount is amortized on a straight line basis over the life of the bonds, so $30,000 divided by 40 periods. And our interest expense is simply the plug. It's our cash that we pay plus the amortized discount. On December 31st, we don't have a cash payment or coupon payments that's due. It's not due until January 1st, but we do have interest payable in the amount of $30,000. We will once again amortize $750 of the discount on our bond. The two of those added together gives us our interest expense of $30,750. We will continue to make these two entries over the 20-year life of the bond until the bond matures, at which point in time we will debit bonds payable for $600,000 and of course pay cash of $600,000 to the investors. In our last scenario, the bonds are issued at a premium at a price of 102% of par. Once again, as always, we record bonds at their par value or face value, so we will credit bonds payable for $600,000. In this case, though, we are going to receive $612,000 in cash. Of course, debits don't equal credits, and we will credit premium on bonds payable for $12,000. We will amortize that premium over the next 20 years. Again, semi-annual bonds, so for 40 periods. Let's take a look at our entry of payment of interest and related amortization on July 1st, 2020. We're going to have to pay cash of $30,000. Again, that's the $600,000 face value times the 10% stated rate times 6/12 for half a year. We are going to amortize the premium in the amount of $300. And again, that's $12,000 divided by 40 periods. Debits don't equal credits, and our plug is basically to interest expense. This is the $30,000 coupon payment less $300 in amortized premium. On December 31st, we actually don't have to pay interest, but we have interest payable, again, in the amount of $30,000. We'll pay that interest on January 1st. Once again, we will amortize $300 in premium on our bonds payable, and we will record interest expense for that 6-month period in an amount of $29,700. We will record these identical entries every year for the next 20 periods or 20 years. At the end of 20 years, we will pay the investors $600,000 in cash, and we will debit bonds payable for $600,000 as well. You can notice that $12,000 of the cash we received up front is an overall reduction in our interest cost or borrowing cost on these bonds. The bonds pay a stated interest rate of 10%, but investors are willing to buy them at a lower yield. We will solve for the implied interest rate in a later problem, but investors are willing to lend money to Sion Dion Company for 9.77%. But since the bonds are paying 10%, they're willing to pay a premium. We get extra cash up front, and this represents a reduction in our borrowing cost. In the situation when our bonds were issued at a discount, in other words, investors didn't think the 10% stated interest rate was quite high enough and didn't really want to buy the bonds until we lowered our issue or selling price, we could find that the effective cost of borrowing is 10.6%. That is, investors are requiring a 10.6% rate of return to lend us money. Since our bonds are only paying a 10% stated rate, investors will have to earn the additional interest in the form of a higher or lower price, which is effectively that amortized discount. So at a 10.6% interest rate, they would expect to receive more than $30,000 every 6 months. But that's all they're receiving. They receive their additional return in the form of having only paid $570 for the bonds up front, and yet getting $600,000 for the bonds when they mature. Which again is why we record interest expense each period in an amount greater than the cash we actually pay to investors, the difference being that amortized discount.